History was made this week with the death of Queen Elizabeth of Great Britain, the longest-serving monarch in British history, overshadowing, for a moment, economics and currencies and central banks, and yes, even wars. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers and Rick Rieder of BlackRock. Queen Elizabeth of Great Britain passed away this week at the age of 96, leaving behind a 70-year reign and a new king, King Charles III.
Queen Elizabeth was a life well lived, a promise with destiny kept, and she is mourned most deeply in her passing.
But even as the world took a moment to reflect on an era that has passed, it continued to contend with the current one, where war in Ukraine has led to an energy crisis in Europe, as President Putin insisted that he is not using oil and gas as a weapon, even as he shut down his Nord Stream pipeline indefinitely.
Nord Stream 1 is now practically shut down, and everyone is saying Russia is using energy as a weapon. More nonsense. We deliver as much as our partners need.
And the ECB reacted to the inflation triggered by the energy crisis by raising rates an historic 75 basis points, with more to come.
The Governing Council today decided to raise the three key ECB interest rates by 75 basis points. This major step frontloads the transition from the prevailing highly accommodative level of policy rates towards levels that will ensure the timely return of inflation to our 2% medium-term target.
While in the United Kingdom, just before news came of the Queen's death, the Prime Minister she had installed only 2 days before announced caps on household energy costs and promised to pull her economy through.
I have a bold plan to grow the economy through tax cuts and reform. I will cut taxes to reward hard work and boost business-led growth and investment. I will drive reform in my mission to get the United Kingdom working, building and growing.
In the United States, markets waited for the next Fed decision, now less than 2 weeks away, with all indications that the FOMC will stay the course and keep raising rates until it's sure inflation is under control.
We're in this for as long as it takes to get inflation down. So far, we've expeditiously raised the policy rate to the peak of the previous cycle, and the policy rate will need to rise further.
And when all was said and done, the markets had a good week, at least if you were long, with the S&P 500 up 3.65% in a shortened trading week, with much of the gain coming on Friday, while the NASDAQ tracked the S&P nicely, up over 4%, with the gain once again on Friday. And all this was despite a rise in bond yields, with the yield on the 10-year ending the week just over 3.3%, up about 12 basis points. Here to explain all this equity appetite are Saira Malik, Chief Investment Officer at Nuveen, and Jim McDonald, Northern Trust Chief Investment Strategist. Welcome to both of you here to Wall Street Week. So let me start with you, Jim. What do we read into this market? Are happy days here again? I mean, we did have a really nice gain this week.
David, I think you could spend a couple hours looking through all the fundamental data and not find anything that really supported a big increase in risk appetite this week. So I think you really have to attribute it to the fact that we had a couple weeks of softness preceding this, and then sentiment is terrible, and then technically the market is making higher lows, so technically it looks okay here. But if you think about what's going to drive the market over the next 6 to 12 to 18 months, the growth outlook is deteriorating. Europe's likely in recession. China's clearly in recession. The U.S. 50-50, we think, over the next 12 months. The Fed and the ECB are raising rates resolutely. And the inflation picture, while improving, is probably overly discounted in the markets. A one-year break even on the tips is at 2%. So we think that the environment is probably not as robust as this week's market action might indicate.
Well, I'm sorry, Sarah. When I hear 2% in a one-year break even, that sounds like maybe inflation's coming back down again.
I think that number is coming back down. Inflation's moderating. We'll likely see a little bit more moderation when CPI comes out next week, but that slope is probably too aggressive. I think inflation will remain sticky. We have higher wages and higher shelter prices. Those likely stick around, and that's going to keep core inflation numbers probably much higher, and I wouldn't be surprised to see that break even actually increase over time. The other thing we're watching for is the Fed. Before we decide if this rally is sustainable, we'd want to see more signs of a Fed pivot, and we're not seeing that. So we agree with Jim. This is probably not a sustainable recovery.
Well, what about the Fed pivot? Is it dead, effectively? I mean, it certainly sounds like Jay Powell recently has not been saying much that would be consistent with a pivot.
I don't think we're going to see a pivot in early 2023. What Jay Powell has been saying is that he's going to do what's necessary to fight inflation, even if that comes somewhat at the expense of the economy. And given that inflation likely has these sticky components to it, I think he continues to raise rates, likely 75 basis points at the September meeting, and then more moderate rate increases from there. If anything, you'll see a pause in 2023, but you won't see rate cuts until we hit a recession and we see that demand destruction.
Yeah, and David, we've seen in the last month a reduction in the cuts that the market has priced in. They were pricing in 50 basis points of cuts in 23. It's now come down to just 25 basis points. And what I'm most interested in keeping an eye on is the labor markets. I think the Fed can't stop raising rates because growth is hurt. They can't stop because the market is struggling. They need to see the unemployment rate increase to give them cover to be able to start slowing down the pace of increases.
So next week we get CPI numbers, right? What are those going to tell us, Jim? What do you think about headline and core?
Well, I think the key is going to be the pace of improvement. I think there's very little doubt we're going to see improvement in the overall rate. But as Saira mentioned earlier, the progress on housing and the progress on labor are really the two most key. And they're key because the supply issues on both of those are really considerable. And the only thing the Fed can do is hurt demand. They can't increase supply in either of those areas.
So, Saira, this doesn't sound that rosy about the U.S. economy and where we are. But if you compare it with Europe, or you compare it with China, for that matter, we're in a lot better shape, aren't we? What about that divergence among the economies?
I think the U.S. is still the safe haven region of the world to be in. The economy is much more resilient. That's giving the Fed leeway to continue to raise interest rates. We're not seeing that resiliency in the rest of the world. And that's also why the dollar is so strong, and we expect it to remain strong, because the U.S. stronger growth, higher interest rates, the currency will be that safe haven trade. And that's an issue for earnings going forward. Jim mentioned employment. We're also worried about earnings. Consensus has been pretty positive this year on earnings growth. And our concern is that earnings will eventually get hit because of the strong dollar, margin compression because of inflationary costs. This is going to be an issue for companies that don't have pricing power.
So that was one of the big stories of the week, right, Jim? The dollar was setting record after record after record. We had Bill Dudley, the former New York Fed president, on Bloomberg this week saying he thinks the Fed actually wants that strong dollar because it actually slows down the economy.
Yeah.
But what does it mean for investors?
Well, it's an issue for investors from the standpoint that it is positive that it will slow growth, but it does hurt earnings. And it's a negative for the international investments where you're seeing the depreciation of those currencies. Foreign markets have actually done not as badly, but when you translate them back into dollars, it's really been a much more difficult market.
Does this say anything about small caps versus big caps?
Well, it does. The small caps would tend to have a little bit less exposure there, but conversely, small caps are more exposed to higher interest costs and more difficulty in handling higher input costs. They tend to not have as much pricing power. So they win on one front, they lose on the other.
So, Saira, what are we all missing? I mean, you're at Nuveen, you see all this stuff. I know you've got some secret sauce there. What are the markets missing? What are we missing?
I think one of the key issues for the markets is valuations. This is what we're surprised to see, is that valuations for stocks actually are not that cheap. And even with earnings at risk, they could look even more expensive. If you look at history, during periods of high inflation where you tend to eventually hit a recession, market returns can be quite strong after that. But if you look at valuations in those historical periods, they were much lower when that happened. So that's why we're more concerned about the markets and think that it's likely that valuations need to crack before we would get interested.
Oh, that's interesting. So we got further to go down, you think, at least. So do you agree with that, Jim, or do you have something else you think the markets are missing?
So our experience is that while valuations clearly are important, they're much more important to long-term returns than they are to 12-month returns. There's a very little statistical relationship on a short-term basis. So we don't look at valuations as a timing tool, but they're very important for intermediate to long-term returns.
So what about the cause and effect of the U.S. dollar strength, Saira? Is that because our economy is that much stronger? Actually, I talked to Larry Summers, who said it's because we've got such a strong energy position, particularly compared to, for example, Europe, which is struggling so badly.
It's a combination of many factors. I think it's correct. It's because of our strong energy position. It's because of our relatively stronger economy, our pace of aggressive rate hikes. All of the things make the dollar stronger. And another headwind for the economy and the markets going forward, particularly earnings.
So as you look forward, Jim, you think this dollar is going to continue at this strength or even get stronger?
It probably will continue at this level. I'm not sure how much stronger it will get from here because we are going to get towards the end of the Fed cycle sooner than we will other central banks. But an important part of our investment philosophy is you do not want to take a lot of risk in predicting where currencies are going to go because it's an incredibly difficult thing to do. Hedge your liabilities and use your risk budget on other investment ideas.
Certainly sounds sound to me. You agree, Sarah?
I do. I think that's a great philosophy.
Okay. Saira Malik and Jim McDonald will be staying with us as we get their thoughts on what the smart investor does with their portfolio, given what we've just been talking about. This is Wall Street Week on Bloomberg.
Well, it wasn't pretty. There was unforgettable heroism among the victims and the rescuers. But the financial markets, even after what was supposed to have been a useful time out, staged a historically panicky retreat, mumbling legalistic rationalizations like fiduciary responsibility as an excuse for what rapidly descended into unchecked hysteria.
That was Louis Rukeyser, of course, describing the immediate market reaction to the tragic events of 9/11. That was 21 years ago this coming weekend. A reaction delayed by the closing at the time of the New York Stock Exchange and heroic efforts to get it back up and running after just 6 days. Still with us are Saira Malik of Nuveen and Jim McDonald of Northern Trust. So I'm happy to say we do not have anything like the tragedy of 9/11 that we're confronting right now. At the same time, there's a fair amount of pressure on the markets, I think it's fair to say. In this environment, how does one construct a portfolio?
Well, it's not all doom and gloom when we think about portfolio construction. There are ways to build portfolios that are resilient to inflationary environments across asset classes. Now, the typical 60-40 equities fixed income portfolio has struggled this year. But within equities, there's companies that are more resilient, like dividend growers. These are companies that continue to grow their dividends over time. Broadcom's a great example of that. In fixed income, an area that people may not be thinking about if we're approaching a recession is high yield. You can get returns of over 8% in high yield fixed income, so you're paid to wait until spreads tighten, and the companies are higher quality than they used to be. And then finally, outside of public equities and fixed income, look at real assets. Farmland is an area which has built-in inflation escalators often in their contracts, so they can benefit as CPI increases. Also, private real estate. Even the real estate market has issues on the private side. Similarly, leases with built-in inflation protection. Those are key for markets where inflation is going to be increasing.
So, Jim, that's a lot to chew on, but let's start with one of them, which is credit and high yield. Where are you on that?
So we're very constructive on high yield. It's our largest tactical overweight with a yield to worst of 8.5% or so. Downside risk of about a third of the equity markets in the high yield markets. You need to think about high yield as a risk asset. So this is not something we're taking investment grade bonds and putting it into high yields. It's much more of an equity substitute in this environment. But that kind of return looks really attractive here. Another aspect I would mention is geographic exposure within equities. So we have a slight overweight to the U.S. and underweights ex-U.S. and in emerging market equities, really reflecting the significant growth issues and inflation problems that are being realized overseas. That's another way to give clients some confidence that we're positioning for what we think is going to unfold over the next 12 months. And lastly, I would say the real asset side, we also very much support having some inflation exposure, whether it's in global listed infrastructure, which has that pricing power, or on a long-term basis, commodities, where we think you can get in a basket of listed commodity producers a yield near 6%. Which is really attractive in this environment.
So we're actually more concerned about commodities, excluding energy, because we think that commodities are very exposed to demand destruction. But energy is a different story, where supply remains tight, demand should remain strong. And what we love about energy producers is that they're being very disciplined this cycle. They're returning cash to shareholders rather than just working to just increase volume. Good for those companies and to keep oil prices beneficial to them.
But Sarah, put together, if you will, the slight overweight to U.S., not much more than slight that Jim talked about, and what you just said about energy, because given this energy situation, one might say it's more than a slight overweight the U.S. Where are you?
We are probably more constructive on the U.S. than the rest of the world. We think the U.S. will continue to be the safe haven trade because of the resilience of the economy versus the rest of the world. Europe could run into stagflationary issues with their aggressive increases in interest rates while the economy suffers. And the emerging markets are challenged because of the continued lockdowns in China and some of the other areas that are having issues. So I think non-U.S. is going to be a struggle, especially with the strong dollar.
And so I would add to that, from a U.S. exposure standpoint, we also like the energy sector. And the other one that we like are technology stocks. They have really struggled this year, improved the valuations, clearly a long-term growth leader globally. And so it's a bit of a balanced approach within a U.S. equity portfolio, liking both energy and technology stocks.
It's interesting, technology stocks tend to struggle, though, when interest rates are increasing because they're considered long-duration stocks, an area, for example, semiconductors, which have even underperformed the technology benchmark. But I think you can find value in some of these areas. This goes back to dividend growers. Broadcom's a company that within the semiconductor space tends to be kind of offensive and defensive, more resilient business with their enterprise demand and also with their software mix, and a nice dividend that's growing over time.
So as you're putting together your portfolio, do you take into account the possibility, or even some say likelihood, of recession or not? Because, for example, when you say high yield's a good thing. I get a little nervous if we're going into anything that's a real recession, right, Jim?
So you have to have a view on what the recession will be if it unfolds. We're at a 50-50 probability in the U.S., but we think it will be shallow. The banking system is in dramatically better situation than it was during the global financial crisis, so credit creation won't really be hurt. Household balance sheets are not in bad shape, so it's much more likely to be a shallow cyclical recession, and high yield with a starting yield to worst of 8.5% gives you a very nice cushion in that environment.
I agree with that. I mean, we're looking for areas, given the environment out there, where are you getting the best bang for your buck? And so even though we do predict a recession, you're getting paid to wait in high yield with that kind of return. You can have that resilient income-producing portfolio in equities with dividend growers, and then look for those asset classes that actually can benefit from inflation, like within real assets.
How important is liquidity in all this? When you start talking about real estate, for example, farmland, things like that, that sounds like I'm giving up something on duration, right?
You're giving up something, you're giving up some liquidity. You're also dampening your volatility. That's why we recommend a balanced portfolio. You want to make sure that you have your publics and your privates within your portfolio so that you do have areas where you can get liquidity if you need it, but also the resilience and less volatile pieces of the private asset classes can be beneficial, especially in this year, which is unique, where the 60-40 typical equity and fixed income portfolios that people have been highly correlated.
All fixed income obviously is not created equal. Where are you in investment grade, Jim?
So we're significantly underweight investment grade. We just don't think that the nominal yield or the real yield opportunity looks particularly attractive. And our number one risk case around sticky inflation, investment grade bonds are not going to do well in that environment. So that's an underweight in our tactical portfolios.
Do you agree, Sarah?
Generally, we would prefer high yield over investment grade for the same thing. You're getting greater returns, more bang for your buck from high yield.
And where are you on tech? Jim said he thinks tech might be a good idea, although, as you said, if the interest rates are going up, typically that hurts tech.
Yeah, I mean, generally, bigger picture, the macro environment is not good for long duration technology stocks. That's why you need to be selective. And we're looking for what we said, kind of offensive and defensive tech together. The companies that either are more resilient because they have healthy growing dividends, or they have pricing power so they can survive the environment. The trade of pre-pandemic, where all technology stocks kind of all did well, I think that's over.
I would just add that the market knows that interest rates are going up and have gone up, and that has killed valuations within the technology sector. So we think that's what's set up the opportunity today. Tech stocks have discounted a great amount of the higher rates.
But it's interesting, if you look at 2023, markets are actually less hawkish than the Fed. So there's a mismatch there. In 2022, markets have now caught up to the Fed's same level of hawkishness. But 2023, markets are saying, you know what, we expect less rate hikes than the Fed expects. And we'll see if that happens. Probably depends on if we hit that recession and inflation finally drops significantly.
We've had this discussion, terrific discussion, but we have not mentioned healthcare or biotech at all, which strikes me, given what we've been through, the pandemic and everything else. What do you think about healthcare?
Just big regulatory risk. So the biotech stocks have been crushed. Now, maybe that will present an opportunity when we've got better clarity from a regulatory standpoint, but I think that's been the biggest headwind for healthcare.
That's an issue for healthcare, but also when people are looking for growth stocks and the tech stocks are out of favor, they tend to go more defensively in terms of growth stock. Healthcare does fit that area. So when you get into these risk-off environments for growth, healthcare can actually outperform.
What about, I mean, you mentioned dividend growers, but what about balance sheets? What about EBITDA, the old classic issues? Are you paying a lot of attention to that at this point, Sarah?
We are, because in an inflationary environment where costs are going up and costs of debt are increasing, I think this is where balance sheets and high-quality companies become very important. Jim mentioned that small caps less interesting. You know, they can be more at risk in periods such as this if their balance sheets aren't as strong and they are smaller companies. So, you know, we think that is a key factor, as well as pricing power. Who's got the pricing power to overcome inflation?
Yeah, so we're a big believer in quality within the equity portfolios. We want to do it on a sector-constrained basis because you can find yourself way mismatched against the overall market. But quality of capital deployment, quality of balance sheet condition, all good things for long-term stock performance.
I say the biggest one for last, and we don't have very much time, China. Should we be concerned about China, the lack of growth in China, Jim?
Absolutely. So we think that the growth initiatives that have been taken have been anti-growth. We think that the zero COVID policy is going to be a problem for at least the next 12 to 18 months until they get their own world-class vaccine, and we just don't see that on the horizon yet.
Where are you
on
China,
I would echo
Sarah?
same thing. I think there's just going to be macro issues there that are difficult to analyze, and that makes it tough to invest in.
At the same time, they could change their course, right? I mean, leading into the part of Congress, I mean, President Xi needs to get the economy going.
Seems a little late to be doing that. I think he would have done that earlier if he was going to do something really big.
And they have talked about that a lot, but we haven't really seen the execution. That's what we'd be waiting for.
Okay, this is really, as I say, a really terrific discussion. Thank you so very much. That's Saira Malik of Nuveen, as well as Jim McDonald of Northern Trust. Coming up, we're going to take a look at what's in store next week on Global Wall Street. That's coming up right here on Wall Street Week, and we are on Bloomberg. This is Wall Street Week. I'm David Weston. It's time to take a look at next week on Global Wall Street, starting with Juliet Sally over in Singapore.
Thanks, David. Well, this could be another telling week for the Chinese economy, just weeks out from the all-important Party Congress. Friday sees the monthly data dump for August, which are likely to show the recovery stalling. More stimulus perhaps needed, but Bloomberg Economics thinks the PBOC will probably stand pat on a key lending rate this month because it's loath to do anything that could hasten the yuan's depreciation. Elsewhere, Sri Lanka's second quarter growth report will likely confirm a deepening recession. New Zealand's growth probably bounce back from a contraction, and in Japan, producer prices may edge up as yen weakness inflates the bill for oil and other imports.
U.S. markets next week will be focused on Tuesday's release of inflation data for the month of August. Consumer prices decelerated in July, and while that trend is expected to have continued in August, headline CPI, it's still projected to be above 8% for a sixth straight month. And core CPI, which excludes food and fuel, is seen accelerating to back above a 6% growth rate. In addition to inflation data, the government will also release data on industrial production, small business sentiment, and monthly retail sales. Year-over-year retail sales are expected to be flat for a second straight month as consumers wrestle with elevated prices. Those reports will be the last batch of major economic data before the Fed's next policy meeting, which begins September 21st. And finally, keep an eye on Twitter next week. Shareholders on Tuesday will finally get their formal say on whether the social media company should force Elon Musk to follow through on his proposed $44 billion acquisition of the social media company, a deal that Musk has sought to cancel.
Coming up, it's an uncertain time for investors, full of risk without a lot of certain return. But Rick Rieder of BlackRock thinks that there's the potential for the patient investment to really do quite well. That's coming up next on Wall Street Week on Bloomberg. They say it's always darkest before the dawn, and there's plenty of dark out there for investors right now. With the stock market off,
overall positioning has still been pretty depressed, and sentiment reflects that.
Inflation still raging,
inflation stickiness is not going away anytime soon,
and the Fed intent on continuing to hike rates.
It was fairly obvious coming into the year that the Fed would tighten.
But there may also be some early rays of light, with commodity prices coming back down.
If the Fed continues to tighten tighten, we believe the dollar will turn back up and these commodities will continue to fall.
So the question is whether this is a false dawn or whether it's actually a good time for the patient investor to position for a rosier future. And to tell us which of those it is, we welcome back now Rick Rieder, BlackRock's CIO for Global Fixed Income and also head of the Global Allocation Investment Team, which includes the BlackRock Strategic Income Opportunities Fund, rated 5 stars and gold by Morningstar. I'm sure you don't want to brag about that, but I think we should brag for you, Rick, there. So,
you're very kind.
Rick, give us your sense of this market from your point of view. I mean, you're putting money to work all the time, both on fixed income and also in equities. What do you make of this market right now?
So, David, you think about it. We came in the beginning of this week and said, well, you've got energy caps, you've got the turning off of Nord Stream, you've got China growth, China COVID, China Taiwan. You've got a series of issues that are hard to get your arms around. By the way, the goods sector of the U.S. economy is softening. So there's a lot of challenges out there in the world. That being said, if you take a step back and you think about, as an investor, with the Fed moving rates higher, all of a sudden, you could buy short-end interest rates at levels we haven't seen in a really long time. I was thinking about a year or two ago, you had to pay less than 1% to fund companies, 50 basis points. I saw Amazon did 25 basis points in 3 years. All of a sudden, you could buy short-end assets at 4, 4.5, 5%. Put some money to work, get some carry, and then tactically look at areas that are where there's opportunity. And listen, you can get really, really concerned about where the world is. When you step back and think about U.S. economy, we think is going to have nominal GDP this year of 5%. Nominal GDP of 5. You've got a service sector that's doing well. You've got a healthcare sector that's doing well. You've got parts of the economy. So there's things to do. While it is one of the most challenging, uncertain times that we've seen in markets in a long time with central banks tightening, there's some things to do in the markets, and there's some reason to look at some opportunities out there.
So the difference, as my math works, from 0.25% to 5% is a pretty big difference. That sounds pretty good to get that kind of return. At the same time, it depends on what's going on with inflation, right? We got CPI numbers coming out next week. If we've got a headline inflation around 8 and we've got core around 5 or 6, that 5% doesn't look quite so good, does it?
It actually doesn't look good at all. And if you assume that we're going to be running at those sort of levels for a period of time, but you look at where the inflation markets are, where real capital, including ourselves, are transacting, and today we were locking in inflation in 2 years at under 2.2% for 2 years. 5 years are around 2.5%. 10 years are around 2.4. So if you say, "Gosh, I can buy 1 and 2 year high quality assets at 4.5 to 5," I'm protecting my inflation risk in the low 2s. Boy, I'm locking in real rates. I'm financing companies, by the way, not just companies, commercial mortgages. I'm financing companies with a real rate that's pretty attractive. And you can actually, people can talk about the stickiness of inflation, which is real. Shelter inflation's high, wages are high. But boy, you can do some things in the market that can certainly hedge your inflation risk and carry quite well in the market today.
So if the inflation risk is not what some people fear it is, it's actually coming down, why is that? Is that because the Fed is tightening, it's tightening the money, or is there something in the notion that the supply chain is loosening up some?
So I think it's two parts. One, I think the Fed deserves an awful lot of credit. Listen, there was enough criticism to go around, myself included, that last year they waited too long QE. I think that's been well chronicled. This year, they cannot be any more clear. They cannot be more strident in inflation is what they're doing, and they're not going to back off that. And, I think they're going to get the funds rate to 4, 3 3/4 to 4, probably 4. And then I think they're going to let long and variable lags of monetary policy do their thing. So they're pretty clear. So I think there's a credibility from the Fed that I think you've got to applaud in terms of what they're doing today. Second is, as you said, supply chain. You see real improvement in supply chains. You see it in some of the PPI numbers. You see freight costs coming down. You see commodity costs coming down. So there are some reasons to see that, gosh, some of this inflation, by the way, you also see in inventory levels. Look at retailers, their inventory levels are up quite a bit. In fact, there's not places to put some things today. So you'll see some price discounts there. And by the way, in semiconductors, it's not perfectly solved around supply chains. But look at some of the semiconductor stocks these days. People are concerned about oversupply. That's not something we've talked about for a long time. So it's better. and there's some reason for optimism. But I think you have to start with a central bank that is, there is no ambiguity, and they're quite clear in how they're communicating that.
Talk about the divergence of the economies around the world, because we're sure seeing, we saw the ECB raise 75 basis points this week, and they say it's going to get worse before it gets better. They've got an energy crisis in Europe. I think it's fair to call it that. China is slowing down. It's challenged. Japan has its own challenges. Are there opportunities or challenges in that divergence among the economies?
So, I mean, boy, there's such a multifaceted question, David. You think about, why is the dollar doing what it's doing? Financial assets are being purchased in the U.S. because it is a safer haven. It is hard to say, gosh, Europe is going to be out of woods. We don't even know what the weather is going to look like over the next couple of months, let alone whether Nord Stream comes back on or not. So that is tricky. China, as you talked about, Nick, earlier in your show, around the COVID dynamics, around the U.S., the trade dynamics, China, Taiwan, et cetera. Those are hard. So, U.S., it has to be your source of best opportunity and the place where you sleep better at night. But parts of the European, we've been investing in some of the European credit markets, particularly some of the shorter duration. You get comfortable that, you're not going to have significant defaults, particularly of big companies that have revenues, have sales outside of the region. So we've been doing some things in credit in Europe, again, in moderate form because we're more comfortable in the U.S. And then tactically in other parts of Asia, we've taken advantage of some opportunities. But, it's no mystery as to why the dollar is well supported. Financial flows, corporate flows are certainly heading into a region that certainly seems to be well supported by the service sector and other parts of the economy today.
And Rick, how much of that U.S. position right now is strictly energy? Because we're an energy exporter at a time that a lot of the rest of the world needs energy desperately. And that's a macro factor that's not likely to go away right away.
It's a really, really big deal, David. I mean, it's not just you think about crude or nat gas. The fact that, when the U.S. shifted a number of years ago to being a net exporter of fuel, boy, you change the paradigm around your self-sufficiency, your independence. And you think about Europe. I was in London this week. I was in Europe the week before. And by the way, inflation doesn't seem to be that bad if you're using dollars when you're traveling to those locales. And but boy, you look at Germany, you think about how vibrant, how strong, how delevered that economy is. But then all of a sudden, you have a nat gas reliance that really questions whether do you have to shut industry for a period of time. That becomes tricky. Italy becomes extremely tricky, and the UK is in a boy. I witnessed it firsthand. When you talk about fuel costs, and you talk about your electric bills going up 3, 4, 5 times, let alone you've got the central bank has to raise rates, so you've got floating rate mortgages that are moving higher. Tough, really tough dynamics. And I think the world is going to realize, and by the way, not just fuel, supply chains, how you think about your supply chains, how you think about vertical integration of your company. I think a lot of this is part of why inflation probably stays a bit stickier over a period of time, is companies are going to be more thoughtful about what are their points of vulnerability and how do you mitigate those going forward.
Rick, help us make some money here about where we really should be investing if we're thinking about for the medium long term. It sounds to me like short-term credit. You've mentioned that more than once in Europe and here in the United States, what's going on. What beyond short-term credit?
So, I like the credit markets generally. I think you can take some risk in high yield. Well, you can pick up assets at 8 to 9%. That are reasonable credit quality. I think the high yield market. I think generally the credit market. By the way, I think it's cheaper than equities. Think about what's your return paradigm in equities when you've got margin pressures, uncertainty of top line revenue. Are you going to create 10 to 15% return? Wow, gosh, if I can get it in debt and I can get that 8 to 9%, I think that's intriguing. The short end of the curve to me, and the ability to just take not a lot of interest rate risk. And not a lot of credit risk. That I also think is interesting. And listen, I still think you need to be in the equity market.
Yeah.
And I think there's some opportunities in equities. I just think you got to think about the quality companies that have durable cash flow across industries, healthcare, parts of tech. We would call them GARPy companies that are good cash flowing. That have some pricing power. I still think you got to be in the equity market. Again, I'd rather. For the first time in a long time, I'd rather be in more fixed income than equities because of where rates are today, and you could be up the stack in a more uncertain time. But listen, I still think equities are okay, for the long term, certainly are okay.
But it sounds like, if I'm interpreting you right, on equities, you spend a lot of time looking at balance sheets and things like cash flow and EBITDA and all those old-fashioned things, leverage.
Yeah. Well, there's no better time to do that. And we've lived in a kind of a crazy world the last couple of years where all that stuff, when you're in QE, it's almost get as much beta in the portfolio, ride the wave as much as you can. And now I think you're going through an era where, gosh, you see the volatility some stocks. And by the way, the liquidity of these markets is not great. So if you have a bad piece of news, these stocks depreciate pretty darn quickly. So, we're spending much more time on the intensity of gearing and cash flow.
Yeah, time to get your sharp pencil out. Thank you so much. Always great to have you with us. It's Rick Rieder of BlackRock. Coming up, we're going to wrap up the week with our special contributor, Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David West, and we're joined once again by our very special contributor, Larry Summers of Harvard. Larry, welcome back. One of the big events of this week, besides the Queen passing, was actually what's going on with currencies, with the U.S. dollar setting record after record. At the same time, the euro is really falling off, and boy, look at the yen. What is going on with the economies?
Look, the United States has a huge advantage. We've recognized it for a long time in terms of our lack of dependence on egregiously expensive foreign energy. And that is benefiting the relative strength of our economy. At the same time, we've mounted a stronger response macroeconomically to the pandemic. Our central bank is moving faster to do necessary tightening with respect to monetary policy, given inflation, and all those various factors are making us a safe haven, a mecca for capital, and that's causing resources to flow into the dollar. It's remarkable that people were saying that the dollar's day was past not very long ago, given its current strength. And my guess is that there's room for this to continue. You know, the euro was in the low 80s against the dollar 20-some years ago. And in some ways, the relative fundamentals of the United States compared to Europe are even stronger now than they were then.
So, Larry, there's talk actually about the possibility of intervention in Japan to try to support the yen. Given what you just said, that it's larger macroeconomic factors, is it possible for Japan actually intervene and actually shore up the yen?
I tend to be skeptical that intervention can have sustained impacts. The capital markets are just so big, even relative to the resources that the authorities have, that I would be surprised in today's world if interventions could have large, sustained impacts on maintaining the value of the yen. I think the more fundamental questions for the yen involve the level of Japanese interest rates, both in the short and over the longer term, and the extent to which the Japanese will at some point feel comfortable raising those interest rates, which is not a simple proposition given the magnitude of debts in Japan.
So we're seeing a different sort of intervention over in Europe, both with respect to the United Kingdom, where the new Prime Minister, Liz Truss, now is trying to impose a cap on the cost to households. We also have the possibility of a price cap being agreed upon in Europe. Is that a reasonable intervention? Is it likely to be effective at dealing with the runaway energy costs, particularly in Europe?
Look, it's an extraordinarily difficult situation, and it's a mistake to be too judgmental from too far away. But when I saw the emerging plan, it reminded me of standard Latin American populist approaches. Fix the price and commit to unlimited subsidy. And those policies often have not worked out well at all for those who implemented them. And so it seems a very dangerous course. Now, I think we ought to give the British authorities an opportunity to explain the rationale for their policy, to explain the financing mechanisms behind their policies. But a policy of tax cutting, avoiding taxation of windfall profits, subsidizing consumers for low-priced energy in the face of a nearly unlimited potential liability seems to me to at least raise very serious and severe arithmetic questions. And I think people who are thinking about the pound are thinking about that.
Larry, perhaps the story that overshadowed the entire week, not necessarily in economics or finance, but overall, was the passing of Queen Elizabeth II at the age of 96. And I wonder if that gives us an occasion to reflect on what has happened to the British economy since 1952, when she became queen, and to the present time. It's been through an awful lot. It's grown a fair amount at the same time. And what we think is likely in store for King Charles III.
You know, in today's world, there are very few leaders who command nearly universal respect. And there are very few leaders who are able, through decades in the public eye, to maintain that dignity and to maintain respect. And Queen Elizabeth did that, and did it as recently as this year at the age of 96. And it's a quite extraordinary thing that I think history will long remember. She stood for taking the long view. She stood for rising above passions of the moment. And I think those are useful lessons for all of us involved in political economy. Useful lessons when the urge to point scoring or cheap partisan advantage looms large in politics, and useful lessons with respect to economics and economic policy as well. And one has to take a longer view. And so Queen Elizabeth was always acting not with a view to the newspaper headlines, but with a view to the history books. And my counsel to those who will lead Britain politically at this very difficult moment is to do the same thing. And I think that's something we can all usefully keep in mind in every country.
So, Larry, let's convene the Larry Summers Book Club here. What are you reading these days? I understand you have a book you like a lot.
Brad DeLong, my former student, now a colleague at the Treasury Department, now a professor at Berkeley, has written the one economic history book that I think everybody should take a very serious look at. Slouching Towards Utopia is the title, and it chronicles the world from the moment growth really took off in 1870, pretty much up to the present. And the only thing we really can learn from for thinking about the future economy is history. And Brad tells it in a dramatic and strongly thematic way.
And finally, Larry, you were part of history this week in the unveiling of the portrait of former President Obama and First Lady Michelle Obama. You were there. Describe for us what it was like. What were your reflections on that revisit of yours to the White House?
It was joyous to see the former president again and to see so many of the colleagues I worked with in the administration.
Thanks for letting us invite a few friends to the White House. We will try not to tear up the place.
At a difficult moment, hearing somebody talk about hope and change and remember the moments of hope and change was inspiring. President Obama spoke of how he always thought of the presidency as a relay race. It was his task for 8 years to carry the baton. And I think that's a useful idea for us all to keep in mind. It goes back to what we said about Queen Elizabeth. Let's think about what future history books are going to say rather than what 2 hours from now's tweets are going to say. If we could all do that, I think we'll all be better off.
Wise words indeed. Thank you so much, Larry. I really appreciate you being back with us. That's Larry Summers of Harvard, our very special contributor here on Wall Street Week. Coming up, when something's too good to be true, does it have to be? Even if it's baseball? That's next on Wall Street Week on Bloomberg. Finally, one more thought. Everything that goes up must come down, or to put it in financial terms, reverts to the mean. We've seen it recently in things like Bitcoin coming back down toward Earth.
The weight that we've seen on Bitcoin and the crypto space at large.
Downward momentum from a longer term perspective is very bearish right now.
In meme stocks, shooting up and shooting right back down again.
So-called meme stocks like GameStop down 8%, AMC Entertainment also down.
And in those NFTs that were going to take us all into the bold new world of the metaverse.
The NFT market has crashed.
The gloss has come off of that particular world.
And now we're seeing it in the world of SPACs, those special purpose acquisition companies that held out the promise of all the benefits of going public without all those pesky SEC requirements.
The SPAC market in particular, not doing well.
The SPAC craze is over. I think that investor sentiment has soured on the product.
This week, we saw the latest stumble of a SPAC when the company former President Trump chose to help him take his Truth social media company public ran into trouble with shareholders who refused to let it extend the time to close the deal, as the app itself continues to have issues, including a ban from the Google Play Store.
Truth Social, that content moderation piece and making sure that they can kind of abide by the standards that Google expects seems to be the breaking point at the moment.
Which brings us to baseball and to the New York Yankees, the best team in baseball, at least through the month of June, winning almost 75% of their games during that time period, only to revert to that mean with a record well below 500 since then. But in a world of things coming back down to earth, there is one part of the Yankees that hasn't. He's named Aaron Judge, who has already hit well over 50 home runs this season and is on a pace that, with a little luck and a bit of his skill, could approach or even pass Roger Maris's record of 61.
I'm just blessed to be in this position and be with those guys, and looking forward to setting more records with those guys, and hopefully eventually getting a ring at the end of the year.
As big a deal as that is for the sport of baseball, it may be even a bigger deal for Judge's bank account. He was offered $213.5 million in a contract extension at the beginning of the year, only to turn it down and bet on himself and decide he was going to have a new contract at the end of the year. Well, that bet, it looks like it's likely to pay off. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.